In investing, as in the rest of life, risk and reward are two sides of the same coin. On one side is the reward, the potential for gain, and on the other side is the risk, the potential for loss. You can't have one without the other. But a lot of investors, particularly professional investors, are always looking for ways to shave off a little from the risk or add a little extra to the gain, or both. In industry jargon, we call that alpha. It sounds simple, doesn't it? But the problem is, in real life, it's almost impossible to pull off consistently. So how could an advisor provide this elusive alpha without trying to outsmart the market? Vanguard, the mutual fund company, has studied the value of professional advice, what they call advisor's alpha, and they say that a good advisor could potentially add as much as 3% per year to their clients' returns. Vanguard describes 6 areas where an advisor can potentially add this value. Suitable asset allocation using broadly diversified funds or ETFs, cost-effective implementation, meaning the use of low-cost funds, periodic rebalancing back to the target allocations, behavioral coaching, in other words, providing discipline and guidance, asset location, which is the strategic placement of assets between taxable and tax-advantaged accounts, and spending strategy, which involves managing the order in which withdrawals are made from those two types of accounts. Now that 3% figure is not exact, of course. It's not consistent from one year to the next, and it'll vary depending on the client's specific situation and what the advisor actually does for the client. The point is that a good advisor who consistently applies these strategies can add real value to your portfolio.